When we talk to business owners, so part of my practice is representing founders and business owners when they sell, and usually to private equity. First question is why? What are your goals? What are you trying to accomplish? And everyone has a different goal, right? If you're 70 and you don't have kids in the business and you want to sell fully out of the business, that's one thing. If you're 45 and you're just cranking along and you really just need help getting to that next stage or professionalizing or growing, then that's a different conversation. And so a lot of times it's important to understand the why so that you can find the right partner for that transaction. And when you don't have the why clearly encapsulated, that's where I think you end up with people who end up in relationships they shouldn't be in.
Hi, everyone. Welcome to another episode of the On Point podcast. Today, Carlos and I had the privilege of speaking with a very special guest, a friend of ours who we've known for many years, Aaron Slavens. Aaron is the chair of the National Private Equity Practice at the law firm of Holland Knight, where he and his partners have built one of the largest and most successful corporate law practices advising private equity firms and business owners throughout the United States. So it was a really fascinating conversation. We touched on everything from the state of the private equity market to private credit to all that's taking place in technology and innovation, and how AI is impacting the private equity landscape.
And I think he had some great advice for founders when they're considering selling a business. And one particular segment which we both really enjoyed was how he always starts with why when he talks to founders about why are they selling the business and what are they looking to achieve. So I think there's a lot of great tidbits in this episode for business owners and, folks in private equity as well.
Absolutely. Well, we hope you enjoy our conversation with Aaron Slavens of Holland Knight. Today, we're here to talk about an important topic, private equity, one that I think confuses but also intrigues a lot of people. And pleased to have Aaron Slavens from Holland Knight with us today. Aaron's not only a great attorney who runs the private equity practice there, but somebody you and I have known for, I don't know, like 15 years at this point.
It's been a long time. Yeah, excited to be here.
Together.
Yeah.
Well, thanks for joining us.
Thanks for having me.
So there's so many ways we could go with this, but I think the way to begin is probably just to talk in general about like what we're seeing in the private equity market. You are somebody who sees an enormous amount of deal flow, are very much plugged in both within private equity firms and then portfolio companies, as well as founders who are potential portfolio companies down the road. On our end, we've seen a period of just huge deal activity going back to, even the post Great Financial Crisis era. What are you seeing today? Is that starting to change a little bit? Is it slowing down or is it as hot as ever?
I think it's still pretty busy. I mean, we've seen growth and look, I can only speak from my experience at the firm, but we're one of the fastest growing firms in the middle market for M&A deals. We're constantly ranked in the top 5 for doing the most number of deals by volume. Yeah, we're seeing it's steady. I think there's been a lot of fits and starts last year, this year. Sort of, there's always something that gives us pause, right? Last year it was tariffs. This year it's a war. But I think overall we're seeing pretty steady, consistent business.
Yeah, my sense is that, we've gone through this period where there's just been an enormous amount of liquidity created through monetary and fiscal stimulus over the years. And for a while that was driving a huge amount of deal flow and, private equity firms raising capital and so on. Some are arguing that that's slowed down, but it feels to us like there remains a lot of liquidity out there. And no matter what sort of you're seeing lately in the headline, whether it's, obviously the war going on right now or tariff impact that happened, a year ago, we're still in this world of a massive money supply and a lot of activity.
Yeah. I mean, that's the sense we have as well. Most of our clients still have dry powder to spend and they want to spend on their current fund, start raising the next fund. And so it's not a liquidity issue as far as finding deals, spending money, it's finding the right deals. Exits, I think, are where there's still sort of this logjam. We're not seeing as many exits as they would hope. You're seeing continuation vehicles. You're seeing people hold assets longer. So I think that's maybe slowing down the market a little bit. But as far as acquisitions and looking for targets and building existing portfolio companies with add-ons, that's all very busy still.
Yeah, we were talking about this another time. Is you still have a lot of those deals that were done pre-COVID at pretty high valuations and in a different interest rate environment. And so even though those companies have grown, with interest rates higher, the cost of financing higher and multiples down, that's what's kind of probably, creating this logjam of exits that have yet to happen. But nonetheless, to your point, like there's a lot of dry powder. I see a lot of these platform companies doing a lot of add-ons. So I'm sure you're as busy as ever for sure. And, it's good. It's good to see the markets, at least from our standpoint, healthy. Although there's certain areas of the market where there's a lot of concern. And I think your data suggests that deal activity in the software space is actually way down, right?
Yeah, I mean, I was looking at our deal activity by industry over the last year, and it's interesting if you look at SaaS businesses and other software. We were pretty consistent with the number of deals we do every quarter. Let's call it 25 deals a quarter in the space. Q1 this year, we dropped down to like 5 or 6 deals. So it's a pretty big drop off from what we've done quarter over quarter for the last probably 2 or 3 years.
Yeah. And it seems like that's a sector that's been in the news a lot, obviously, and under pressure, largely as a result of advances in AI, among other things, right? I mean, there's also the fact that there's been a lot of debt in that sector as a result of, private credit, bank lending as well, private credit and bank lending. But certainly AI is having a big impact on many industries. And I think software is at the forefront of that impact. Are you, in conversations that you're having with both business owners and PE principals alike, is the topic of AI coming up and the impact that it's having on their businesses?
Yeah, I think you can't have a conversation in 26 without mentioning AI. So when talking to private equity funds, I think a lot of them have not implemented it fully into the actual private equity fund activity, right? So they still have analysts, they're still using their modeling or whatever. What they have done is implemented into their portfolio companies for improvements at those levels. So particularly on like the Salesforce side of things, CRMs and any way they can build in efficiency, they have AI teams looking at it and using it. But when I talk to, an MD at a fund, how are you using AI in your day to day? I think they're using it like most of us are, like ChatGPT asking it questions. One place we do see it though is on market research. So a lot of these private equity funds historically will go out and hire a consultant to do market research on an industry. Give me the risks, the benefits, where do you see it going? And I think you can do a lot of that with AI today. And so they're getting sort of at least a preliminary look at an industry a lot faster and easier and cheaper than before. So that's where they're using it the most.
Yeah.
Curious, just because, going back to some of the talks about lack of exits, are you seeing any like changes in like structure to try to overcome what might be some valuation challenges or anything sort of evolving in the marketplace to try to unlock this logjam of
Yeah, I mean, I think the short answer is you're definitely seeing different stuff, right? Continuation vehicles have gone from being sort of a rare occurrence to being very common. And how many, I think a number of funds have done multiple. We'll see sort of structured equity when they're doing deals now too, to kind of guarantee some returns, give them some ability to exit. Yeah, I mean, I think they're getting a little more creative. I think on coming into deals today, there's just a little more critical of the investment structure and what they're looking at so that they have a better exit strategy. I think we were talking about, like, you get stuck with some of these deals from like 21 where people were paying huge multiples. There's not a lot you can do there. I mean, I think they're trying to recap and figure out what to do.
And deals today, to the extent that a deal gets stuck, is it valuation? Is it the financing component? Is it, diligence? Like, where are some of the areas that you would say maybe are kind of, creating a little bit of friction in today's market?
Yeah, I mean, I can only, again, speak from my experience. where I've seen deals get held up, diligence has become sort of a higher focus. So there's not the same pressure there was a few years ago where it's like, I got to do a deal, I got to write the check, and I'm just going to close over stuff. Now, to the extent that there's an issue, and those issues can vary. It can be financial, it can be customer concentration, it can be an issue with a supplier. There's a lot more digging down into that and then putting more pressure on the seller to either address the issue, economically or some other solution. And so you have more pushback on sellers to get better terms for the buyers that I think a few years ago, when the market was really frothy, people were kind of stepping over and just moving on with.
I'd love to dig into that a little bit deeper from the standpoint of the business owner and how they can kind of prepare for a due diligence process with a PE firm or otherwise. But before we circle back to that, I do want to ask a question about something that we're obviously seeing in the news a lot lately, which is private credit and, concerns broadly within the private credit markets. As I'm sure you're aware, certain fund managers have, gated redemptions from their funds to largely to protect, existing investors and so on. But the underlying premise is that there's been a lot of money borrowed, right, in the private markets over the past several years, and that market's grown pretty considerably. Is that impacting at all your business, the way you're seeing private markets, and any of the stresses that are taking place within the private credit market?
It hasn't really hit our portfolio, I guess, our clients. Private credit was a good alternative. And a lot of the stuff we're doing, particularly in the lower middle market, right? There's always sort of been this relationship with sort of alternative lenders that are not big banks because just from the size and maybe complexity of the deal. We've definitely seen a lot more private credit, as you can imagine. Sure. But we haven't really had debt be a holdup for deals, at least in the last year or so. I mean, it's obviously negotiating the terms, getting to the right place, but it hasn't been a gating item to the deal.
Yeah. Yeah, that's interesting. Is the primary term always valuation when you're negotiating terms, or are there other things that you see consistently hold up deals apart from buyer and seller being far apart on value?
Value is always the biggest driver.
Yeah.
I'm working on a deal right now. Rollover and management buy-in is holding everything up at the moment. So the management team has a very aggressive counsel and they're pushing for terms that our client doesn't think are appropriate at the size of management. And so we're, dealing with that. Our client also wants a bigger buy-in. They want a bigger role to know that this management team's focused and going to be along for the ride. And they're, hoping to cash out. So that's, again, it goes to valuation to a degree, but it's also, how involved management will be in the terms around it.
Yeah, alignment of interest.
Alignment of interest is critical.
Correct.
And that kind of goes to what I was touching on earlier, which I think is hugely relevant to a lot of the people that we work with. Is just this: we work with a lot of business owners, as you know, and I think there's always this view toward looking at an eventual exit, and what that looks like can vary in all cases. Sometimes it's a sale of the business entirely. Sometimes it's a private equity partner with a fractional interest in the business. Sometimes it's an ESOP, if they want to, sell to employees down the road. But I think in all cases, there's this thought process around, okay, who would be an acquirer for my business, and what do those various scenarios look like? And I think a lot of business owners, certainly not all, but a lot have preconceived notions about what selling to a private equity firm might be like, and a lot of times it's a negative perception, right? So, and then the conversations that we have with folks, sometimes it's dissuading them from walking in with that basic idea and premise, and understanding that all private equity firms are different, and many of them are partners rather than looking to just extract everything that they can from the existing business and let go of employees, et cetera. So do you see this in your role as an attorney to both private equity firms and in some cases business owners? Do you see that as well, where often there's this perception of private equity in a negative light where maybe it's unwarranted?
Yeah, I think, and again, it kind of depends where you are sort of in the size of deal in the market. a lot of the clients we're working with, when you're sort of the smaller businesses, so a lot of our clients, their first time capital for founders, they need to partner with the founder, right? Like, they don't know how to run this business. There's not a complex management team in place. So it's more of a partnership. It's about growth. It's about, how do we do this? And yes, look, there's different personalities out there and there's different approaches. But for the most part, the clients I work with are viewing it as a partnership, and they want, its personalities have to work, and it's about building it together. I think you do see, sort of, as you go up market, then you start talking about, it's more about consolidation and cost cutting and efficiencies and that sort of stuff. Whereas I think a lot of the stuff we're doing, it's about, how do we throw fuel to your fire, right? You have this great business that's gotten here. How do we grow it? And by helping, what do you need to help?
I would say that we see it similarly in our business, right? Most of the families that we work with, including those that operate very successful businesses, they're not necessarily, the 15, 20, $25 billion businesses where, those transactions are taking place with like large mega funds. They're more middle market, lower middle market. And to your point, I think that a lot of times it's additive when a sophisticated institutional investor comes in and can professionalize the business in certain ways, so they can get, they can maximize value down the line for everyone who remains involved, including the business owner.
Yeah, I think that's right. And when we talk to business owners, so part of my practice is representing founders and business owners when they sell, and usually to private equity. First question is why? What are your goals? What are you trying to accomplish? And everyone has a different goal, right? If you're 70 and you don't have kids in the business and you want to sell fully out of the business, that's one thing. If you're 45 and you're just cranking along and you really just need help getting to that next stage, or professionalizing or growing, then that's a different conversation. And so a lot of times it's important to understand the why, so that you can find the right partner for that transaction. And when you don't have the why clearly encapsulated, that's where I think you end up with people who end up in relationships they shouldn't be in, right? So somebody who wants out of the business ends up with a partner who needs them in the business. And it's a very different dynamic. Or somebody who wants to fully manage has a partner that wants to run it, wants to micromanage. I mean, it's sort of figuring out what your end goal is before you ever, go down the path with somebody.
So the 70-year-old, just picking up on your example, the 70-year-old who wants to retire, who doesn't have succession, is private equity necessarily the right fit? Or if so, maybe there are some private equity firms that are okay, but maybe you have to take a haircut because, they got to bring in a new CEO and there's less skin in the game, et cetera. How would you sort of advise that client?
Yeah, I mean, again, it kind of depends on where they fit in the ecosystem, because maybe they're a great candidate for an add-on for a large platform, right? So it's technically a strategic acquisition, but it's backed by private equity, so they get some of the benefit of future rollover. They are coming into a system that already has a management team, and so it's solving some of those concerns. If you're asking them to go to a small PE shop or an independent sponsor where these guys don't have the management capability, it's probably not the right fit there. And maybe, you mentioned maybe an ESOP, or maybe there's some other alternative. It kind of depends on, again, what his goals are out of it. But yeah, it's important to know up front when you're talking to a buyer, what the buyer's expectations are for the business.
Yeah.
And if you're, getting to that stage where you're later in your career, you're looking to exit, maybe it's worth you building out the team under you ahead of time, right? Go get a good CFO, go get a good COO, start building out a sales team where you're not the only person with the business contacts, so that it's easier for you to step into a senior, like a chairman role or something for the company, but you still have an operating business that somebody can invest in.
That actually gets at something I wanted to ask you about, is what advice could you give to a business owner who's looking to sell maybe in 2 to 3 years, maybe like what you're saying, professionalized management? What other great pieces of advice to help that person, maximize the value of their business?
Yeah, so management is a good one. I mean, getting a real CFO in the business is probably step one. If the business isn't big enough for that, at least get a really good controller, right? Get some sort of financial support in that business. I think look at your revenues and costs, so your customers, your suppliers, and make sure that you're not a single source supplier. Make sure you're not a single, you don't have a single customer, that your concentration spread out. So, because those are things that are going to impact value down the line. So, really work on expanding relationships within the company so that, especially if you're looking to retire and this is your exit, they can't say, hey, you're the only person who knows these customers, you can't leave. And then otherwise, just kind of getting your ducks in a row for things like organizational materials. Like make sure you have copies of all the key contracts and know where they are. Make sure you have all your sort of corporate organizational stuff lined up. To the extent you have litigations and things, maybe it's worth, cleaning it up, settling them, whatever. And then the other thing is think about expenses to the business that are beneficial to you as a business owner today that are going to reduce your multiple, your EBITDA or whatever when you go to sell, right? So are you drawing, maybe you're drawing too low of a salary increase. Think about like putting it to a market salary. Or do you have affiliate businesses that have relationships with this company that are below market terms or above market terms? Think about how that impacts your financials and start to clean all of that stuff up, because better for you to control what that's going to look like than to have, somebody come in and tell you, hey, I'm deducting for this, or you're not getting the multiple on that.
Yeah, I think those are all great points. And one thing that we've seen is when the preparation is not done a few years ahead of time, it can lengthen out the deal process, which can sometimes derail a deal, right? Because it just takes so much longer if you don't have those things already lined up and organized. And momentum is a factor in deals. And so if something's dragging on, it eventually can die on the vine.
Yeah. And look, selling your business is a huge life event, and it's very time consuming and stressful. And if you're not organized when you go into that process, now your attention is really going to be stretched, and you're trying to run your business too, because what happens, a lot of these deals that stretch on, the owner is spending so much time dealing with the sale and takes his eye off the business. You start seeing declines in performance of the business, and now you get retraded on your price and retraded on terms. So it's really important that you're organized. You have a team in place to support you both in the sale process and in the operations of the business, so that you can sort of dual track running a successful business and dealing with selling it.
So, Aaron, you said something earlier that really resonated, because I think we see it in every part of our discussions with folks, and that's the start with why, right? Like there's so many instances that we've seen, and this is true of sales of companies. It's also true of like in investments, right? Where we'll often get approached by a client that says, "Hey, my friend is doing this deal, and I think it could be interesting. I think I should do it too." And sometimes we say, "Well, let's take a step back. Like, why are you doing it? It might be appropriate for your friend, but not necessarily appropriate for you. And so let's really view this through the lens of what makes sense for your individual situation." And I actually don't think business sales are all that different. I was just at a family business conference recently, and I was talking to a couple of families, and the focus of the discussion was liquidity. And half the people sitting around the table thought the only path to liquidity was selling the business. And I said, well, what about a dividend recap, or what about thinking about other possibilities that would involve being able to take liquidity off the table without giving up control of your business. And so I think this instinct that people have to sort of take action, but not necessarily take a step back and say, like, why am I doing this and why am I structuring it in that way, takes place in everything from deal activity to investment decisions that they're making.
Yeah, that's totally true and accurate. We see a lot of deals where somebody has in their head they want to sell, and they get this top line number that sounds really interesting to them. And then you actually dig in on the terms, and it's not so great at the end of the day. And basically the buyer is using the business to pay for itself, right? Like they're taking out loans against the business. They're putting in structured equity. They're doing all these they're making him roll over, whatever the terms are. And when you realize how much cash is actually going to end up in the founder's pocket at the end of this deal, and now they're no longer going to own this business, we asked them, like, you realize you're probably taking more money out, or in 3 years you could do the same deal yourself.
Yeah.
Like, look at debt, look at doing a dividend recap. Maybe it's not a full sale of the business. Maybe it's just growth equity. Have somebody come in for 20%, take a dividend to yourself and keep 10% of that money in, or 50% of the money, right? To go and like build or do the next step till you're ready to see a bigger return.
I think it's important to remember these things are not binary. It's not, sometimes there's this perception of like, I sell or I continue to keep and operate the business. And the reality is there's like 100 iterations in between that can involve all sorts of different, ways of structuring the ownership.
Yeah.
I've got one question for you that I think is really specific to your practice, but also really important for people to know. So just knowing you as long as I have, before you had this tremendous responsibility that you do of managing the whole private equity practice at your firm, you had built a large practice in reps and warranties insurance around transactions, which I think is actually an area that a lot of business owners don't know that much about as it pertains to transactions. Can you take us through a little bit about what that is, why it's important, and how it comes up in deals?
Yeah, sure. Yeah, and for context, right? So. This product's been around for a number of years. I was an early adapter of it. Met some of the insurance companies as a result of buying policies from them. They flew down to Miami, said, you seem like you know what you're doing. Would you want to underwrite? So we've now built, I believe it's the largest underwriting practice in the country. We represent most of the market, looking at deals from the insurance side. So we get this sort of 30,000 foot view of deals that are that have insurance written on them. So the way it works roughly is when you sell your business, you make reps and warranties about the business. So just statements about it. And it covers the entirety of the business, everything from you own the shares to your financials are accurate to there's no environmental litigation. You have employee, you comply with laws. And historically, a founder or seller would have to provide an indemnity against those reps and warranties. And that indemnity would have terms around it. A typical deal would be something like 10 to 20% cap with maybe a basket, and you usually have to escrow that money. So if you were selling your business for $100 million, 10 to 20 million is going to go sit in an escrow at pick your bank for anywhere from 18 months to 3 years. And it's subject to risk. So the insurance companies came along and said, well, wait a second, we can de-risk this for people. We'll sell you an insurance policy. We'll sell the buyer an insurance policy so that the seller doesn't have to stand behind that risk and can take that money out of escrow. And there's variations of how much risk the sellers take. You can, there's a retention or deductible. It used to be about 1% of the deal. Now it's fallen to almost 50 basis points of deal value. So it's a very small number. So sometimes you split that between the buyer and seller. But essentially what happens is the buyer goes out, buys an insurance policy that covers them for all these risks, and it covers the unknown risks, which is the risk that everyone's worried about. If you're selling your business and you have a litigation and you've put a value around that, you can negotiate that with your buyer pretty easily. But you don't know what you don't know, and having $20 million, right, 20% of your deal value or 10% at risk is very hard for founders. All of our clients, when they sell their business, the first thing they say is, we want to be able to sleep at night once I ink the deal. And so this product allows at least a portion of that to be done because you can take the biggest risk of a deal off the table. Now there's carve-outs to like fraud. So if you know of something, you hide it, you don't tell the other side, they still look to the insurance, but they can come to you for fraud and the insurance company can look to you for fraud. But as long as you're being straightforward, you're not hiding anything, it's a really nice product and alternative to historical deal structures.
Yeah, very beneficial.
So basically, what percentage of deals now basically utilize this product, could you say?
It's hard to say on an overall basis. What I would say is in the lower middle market deals, anywhere where there's really private equity involved, it's a huge majority. Huge majority. It's kind of the cost of doing business. So if we're selling a business, any deal over really $20 million enterprise value, it's the price to get it.
Got it priced in.
Yeah.
And how many, and now that the product's been in force for a long time, like how many deals actually end up needing that reps and warranty?
Like how many claims?
Yeah, how many claims?
I mean, there's all kinds of claim studies. I don't have the exact data on me. There is a growing number of claims on it, which is interesting because so part of the reason you buy this, right, especially if you're a private equity fund, the benefit of the private equity fund is, one, you don't have to negotiate with a founder and fight about the terms. But two, when you have a claim, suing your CEO is probably not a good look, and it's probably very difficult. And so I think historically a PE fund might not like pursue a claim that wasn't super material. But if now, instead of doing that, you can look to an insurance company, you're probably more incentivized to go pursue that claim. There's also, some people think that there's an incentive that if I put out X million of premium a year across my portfolio, I want to try and recoup as much of that as possible. So I'm going to look for claims that I might not have looked for under the old dynamic. I don't know how much of that is real, but it's the fear in the market. There's a fair number of claims, but the way the insurance works is pretty good. They really do pay, because if you stop paying, product goes away, right? So, but they are getting more stringent on not paying bad claims. Mm-hmm. So there are people who throw out claims. You're like, you knew about this. It's in your memo. It's on the schedule. That gets tossed. But there are real claims and there is payment. And I would think if I was a seller, I was on a deal and I saw, a $20 million insurance policy get paid out, I'd be pretty happy it wasn't my money.
Yeah, it makes a lot of sense. And what does the underwriting process look like for that? I mean, obviously the insurance company, like any insurance product, they have the benefit of the volume in terms of diversifying their risk. But how are they, how are they looking at underwriting in each case? Yeah.
So, the interesting thing about this, it's a non-recurring, and every deal is every M&A deal is different, right? But the way it works is the buyer goes and engages their broker. The broker gets them some quotes, pick an underwriter. And what the underwriter is looking at is the buyer's diligence and their third-party diligence. So they're not really interacting with the seller. They're not doing independent diligence. They're basically saying, we assume that private equity fund X knows how to do diligence, knows how to hire professionals, their law firms, their QOV providers, their insurance brokers. They know what they're doing. And they're going to ask questions because they're incentivized not to miss something. So then they get those third-party reports, review them, and go back to the private equity fund and their advisors and say, get more clarity around open issues, or if they think something wasn't looked at, why didn't you look at it, or how did you get comfortable with this existing issue? There's some back and forth, and then that's it. And it's a very quick process. From once the insurer gets all of the materials, so the third-party reports and the purchase agreement and the disclosure schedules, usually underwriting call can happen within 24 hours, and the policy can be done usually 2 or 3 days after that.
Oh. What's interesting about that, it's a lot like investment due diligence, right? In the sense that when we're evaluating a private equity investment, for example, we're evaluating the approach, process, risk framework of the manager, not necessarily the underlying portfolio companies that manager is going to buy. And it sounds like from an insurance perspective, it's the same thing, right? You want to know that the buyer has the processes in place to be able to evaluate that deal properly.
That's right. Yeah. I mean, we always tell our clients on the underwriting side, a lot of it is you're underwriting your buyer as opposed to underwriting the deal. Now there's deal specific risks, right? Like you can look at what the industry is and where the risks come in that industry and focus on that. But for the most part, you want to know that your buyer has good processes and has hired the right advisors, right?
Does the industry, will they underwrite non-sponsored deals as well?
Yeah.
They will?
Yeah.
Okay.
Yeah.
How did you sort of come upon this in the early days of the product?
So years ago, we had clients that were not well known in, they're large families, typical Miami, right? And I remember one deal in particular, we had a family that wanted to buy a business from a private equity fund. It was a competitive auction. And they were never going to win the auction because no one knew who they were. We were able to sort of get a meeting with the PE fund through relationships. and say to them, hey, we have this really good buyer. They're creditworthy. They're in the industry. They really want to buy this. We're going to give you a walkaway deal. So you can distribute all of your proceeds to your LPs. You don't need to do it. And had a conversation with them. And that was sort of the first deal. The way I'd heard about it, I mean, it's funny. When I was working in New York at another firm, we had this deal that couldn't get done. Indemnity was being an issue. Somebody said, what about reps and warranties insurance? And everybody in the room kind of laughed. And I had to go call somebody and figure out what it was. And it was way overpriced and the product didn't make any sense. And that was the end of that. But over time, the insurance companies really tailored the product to work for private equity M&A. And they would come and pitch all the law firms. And I had a friend at one of the large shops that would send a guy down to Miami and he'd come meet with us. And we were like, this is kind of interesting. We'll see if it ever works. And then in this particular example I gave you, that was the first real use of it. And then it kind of took off from there.
It's awesome.
Solving problems for clients. That's exactly,
that's what we try and do.
What you try to do. So just on that topic of solving problems, what are some of the most unusual problems you've had to solve to get a deal across the table?
That's a good question.
I mean, that was a pretty good one. You basically created a whole, helped start a whole industry. So that's got to qualify, right?
Yeah. I don't know. I mean, I will tell you the funniest scenario I've had to solve for is we recently sold a business for a family and the whole family worked there. They'd owned the business for years and it was their only email accounts. And the guy, the son who was running the business was like, I can't give my email addresses. I can't give the servers to a buyer. Because not that I'm worried about anything from the business, but from all the personal stuff.
All the personal emails out there, yeah.
He's like, there's all kinds of stuff.
It's a very real problem to solve for.
And so we had to solve for it. And it was a very strange conversation to have with a very professional buyer and a very professional law firm on the other side. We're like, well, we need to go in and kind of delete some of the emails off the server.
Scrub the server.
Can you please allow us? And we ended up, we reached an agreement about private emails, but he's like, I do not need my father's emails being put on the nightly news because he said something inappropriate.
Well, what's interesting is, with technology changing and advancing, I'm hearing more and more about considerations in deals that would never have come up previously. For example, if you have a business with a key person who's a public personality, what happens to their Instagram profile, right? That actually came up in a conversation that I was having with a business owner where that was actually, and you've probably to some extent seen this in other businesses, that was a key issue is, who is going to, not the business's social media profile, but the key person's social media profile as it pertained to the business.
Yeah.
And that would never have come up a decade ago.
Yeah. Yeah. Oh, yeah. We see that stuff too.
Yeah. And now it's only going to accelerate. We were talking about AI a little bit earlier, but I mean, Carlos and I were on a call the other day with, I guess what you would call an AI automation engineer, just learning and understanding how we can incorporate certain things into our own workflows. And, we're blown away. I mean, it's just, with agentic AI on the horizon, the amount of things that you can do in a business in an automated manner that you couldn't even conceive of 3 years ago is just extraordinary.
Yeah. I'll be interested.
Not even three months ago.
Yeah, 3 months ago.
I know. I'll be interested to see how you guys incorporate. Because I mean, even when you guys first started, this place, I remember talking about you're so process oriented. I remember the conversations you had with me about how you were creating your whole system. And I was impressed, what was it, 10 years ago or whatever it was. And I can only imagine if you could now have AI.
Yeah, thank you. Yeah, we've always been a little bit crazy about process. At one point.
Well, let's be fair here.
I've always been crazy about process. That's fair. That's fair. So for those who are not aware, for years we had signs all over the office that said process, and people used to come in and they'd go what's with all the process signs? But eventually I took those down because I think people they had reached the point of annoyance, but yeah, hugely important. So, we're thinking about that. I mean, we're going off topic a little bit, but in a good way, I think. I mean, we're thinking about that a lot in our business because there's so many workflows in any business really that can be prone to human error, that are, maybe inefficient to have a person doing. but that are part of like the infrastructure or backbone of what happens day to day. So I'll go with private equity as an example of that. So, historically, banks and brokerage firms, all their data would get transmitted into our software systems for reporting on portfolios. But private equity is a different animal because you can't really just get a data feed from a private equity firm with all of the, mark to markets or updates to valuations and, capital call and distribution info, et cetera. So largely in the entire financial services industry, that's been a manual process where if you're going to report on a portfolio and it incorporates private equity fund investments, you have one or more people who are actually inputting that data into your systems. And so with, the proliferation of AI tools and now agentic AI, we were talking and I was like, can't we just have an agent basically go through the process that a, member of the investment team would go through to basically receive the notification that there's a capital call or distribution or an updated capital statement, go in, read that PDF file, extract the relevant data, download files into relevant, folders, and then upload that data into the portfolio reporting system alongside our other data without a human being involved in that process at all. And, the answer, as we discovered, is like, you can absolutely build that now. And
we will.
So we're going through
with a little help though,
Yeah. I mean, our key takeaway from that conversation was that nobody in this office is going to build that tool, but right. we can certainly outsource the development of that tool pretty easily.
That's great. Yeah. People always ask me about AI in our practice. And I think a few months ago, I was like, the promise is there, the execution's not. Lately, we've been spending a lot of time with looking at the AI tools available. And I really think we're going to be not that far away from automating a lot of, not the legal work, but the processes that clients paid for that was more ministerial than, legal work.
Yeah.
And so we're looking at all these different tools and trying to come up with a playbook of diligence uses this tool, process like checklists and signature pages and whatever use this tool, reviewing agreements for things like proofreading and whatever, it's this tool, and really kind of create an ecosystem of tools. I mean, it's going to be great. It's going to be great for us in the regard of we'll have time to focus on the things we should be focusing on. Yep. Not have the errors that happen. And I think for our clients, we'll see cost savings to them because, they're not going to get billed for stuff that they don't want to pay for anyway, which is sort of
allow you to advise on more clients.
Right.
Spend more time with more clients.
Yeah. That makes a lot of sense. Yeah. Now, here's a question you probably weren't expecting, but when I think about, who will be listening to this, among the listeners will probably be, law students who see that, the head of the private equity practice at Holland Knight is on here and want to learn about, what it is that you do. What would be your advice or thoughts for law students or those looking to enter the legal profession in a world that is obviously rapidly changing? So there's a lot of discussion today in every industry, in ours and yours, about, what happens to associates that would ordinarily come in a world where technology is advancing and but ultimately those new associates will have to evolve into decision makers like you. How do they navigate that process in this new world?
Yeah, I don't think that there's like a clear answer, and it's something we talk about too because we have associates of how do we develop them into successful professionals over time. Look, if I had a kid in law school today, like, what advice would I give him? I think one is get real good with the technology because you shouldn't come in trying to figure out how to use it. You should come in knowing how to use it. Everything from like how to prompt, right? Just what works, what doesn't work, what should I be concerned about with AI? What's AI capable of today and not? But the other thing is, I think in going into what you were saying about you'll service more clients, right? You'll have more time to service more clients. Really, I think what's going to move the needle is you're going to need more clients because revenues are going to come down on a per client basis. Right. So a lot of, we all know lawyers. There's lots of different kinds of lawyers and lots of different personalities. But I think a big benefit to a lawyer will be sort of that sales piece of it that I think a lot of lawyers are scared of or don't want to do. But the business development side of being a lawyer, of becoming an advisor, of letting people, learning how to kind of go into a room and meet people and talk to them about what you do and give advice where they, think this guy or girl's smart. I want to call them with an issue that I don't want to just put into ChatGPT. Yep. And I think that's really my advice would be, one, learn the technology really well, and two, work on those sort of soft skills.
Yeah.
And learn what you're doing too, right? But that should be just taste. Yeah. You should do that whether there's AI or not. Be good at your, be good.
No, I think that's great advice. I mean, I think in most professions that interpersonal piece is the limiting factor for a lot of people, right? Because there's a lot of smart people who develop the technical proficiency, but being able to blend the technical proficiency with the ability to actually relate to people, I think is a much more rare combination to find. And I think it's true of finance as well.
I think it's all industries, right? I mean, being just a quant now is probably not that strong of a skill as being, a quant who can sell or explain or advise.
100%. So you have presided over pretty significant growth in, both your practice and your firm over the last several years. What's the outlook going forward? You've built, I think you and your partners have built one of the largest corporate practices in the country, that's still growing. So what are the goals as you look out 5 years?
Yeah, we're very bullish on the practice, the firm. Look, as a sort of a plug for the firm, it's a really good platform, right? We're focused domestically. We're in 32 offices around the country. Really good growth, really good professionals. We cover a lot of industries and expertise, and we keep adding and adding high quality lawyers. And I think the idea is we're setting ourselves apart from our peers from providing high quality service and at a price that makes sense for the middle market. We're not trying to be the firms of the world that are, doing the multi-billion dollar deals. Like, we understand the lower middle market, and that's where we want to be, and that's where we see the most growth. And going back to what we were talking about, funds that people are interested in investing in, I think that's where a lot of the capital is coming into in this market.
Yeah, that's where we see the most consistent alpha being generated in those lower middle market deals, for sure.
Yeah, I think and the industry-wide data backs that up. I mean, you look at the numbers of performance numbers in the middle market versus some of the larger transactions, and I think it makes sense, right? Because there are, when you're talking about large transactions and very large funds, the opportunity set is a lot smaller. They've got to pursue very big deals, and that becomes a limiting factor in how they can do. So I think that's definitely.
And as far as because obviously we're here in South Florida, are you seeing a big pickup in deals given how many people have moved to Florida over the last 5 years? Is Florida becoming a hotbed for a lot of the deals you're doing? Or
yeah, I mean, Florida's always been a pretty big market for us. Particularly on the sell side, because it's I've always said it's easier for me to meet a business owner down the street than it is to meet one in Wichita. But
we tend to move here for a reason, right?
Yeah.
So,
I just think Miami in particular, South Florida, has a ton of entrepreneurs, business owners. There's a lot of really strong businesses here. So I see continued growth. I see continued opportunity. And now we actually have the capital that's here too. I predict it's going to keep going. I mean,
booming.
Yeah.
Yep.
Yeah.
Yeah, there's certainly been an influx of capital to South Florida, so hard to imagine that not being a driver for more activity. Well, amazing. Well, thank you so much for joining us. This was a lot of fun.
This was a lot of fun. It's great to see you again.
Yeah,
it's been a while, but
excited to continue collaborating, and hopefully we'll do this again soon.
Sounds good.
All right.
Thanks,
guys.
The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions.